Namaskar everyone, welcome to today's meet. Today in this video, we are going to learn what are the steps involved in order to make an equity research report on any company. So the steps involved in equity research report writing. So these are the following 5 steps you should always follow in order to make a good quality equity research report which really throw some light on what the company does, what is the valuation of any company, what are the competitive advantages a company is enjoying, what is the market share and what is the growth potential for that particular company. So in order to analyze those things, you must do this 5-point analysis of any given company. So the first thing that you must consider is analyzing the macro and micro economy. So first you must analyze macroeconomy and after that you must analyze microeconomy. After that the second step is industry analysis. So in macroeconomy analysis or microeconomy analysis, it includes geopolitical situation, global interest rate, currency exchange rate, global commodity prices. So basically it is related to the global market as well as the market, the economy of your own country where the company is operating. The second step is industry analysis. So suppose your company is operating in pharmaceutical industry. So for that particular company, it has its own dynamics, its own business strategy, its own way of working, its own products and services. So the second most important thing while you are analyzing any company, you must understand that industry very well. The third step is company fundamental analysis. That means whatever is happening in the company, whatever businesses the company is doing, and the way they are earning and how much they are earning and their growth potential going forward in future. This is a part of company fundamental analysis. It also includes management analysis of management, corporate governance, the number analysis, the trend analysis, and etc. etc. The fourth step of making an equity research report, which is one of the most important and an integral part of any equity research report, is valuation analysis and forecast. If you do not know whether the company is undervalued or overvalued, you may have to face huge losses or you may have to miss lucrative opportunities that may exist in a given time in the market. And there is also the fifth and last step, which is ongoing review. So after making an equity research report on any particular company, if you just lock and key and keep it in a safe and forget about that company, then whatever the recent developments are regarding that company, you will tend to miss all those new updates. So that you can be updated and you can be aware about whatever is happening in a particular company, you must review this company on a daily basis. Whatever the news coming related to that particular industry, the particular company, and any economic factor that may affect the performance of the industry as well as the company, which may somehow impact or affect the dynamics of the industry or that company, you must always be analyzing about that. So first let us look at macro and microeconomic analysis. Economic growth trends. So you must analyze what is the current economic growth trends. That means what is GDP, the percentage of GDP means gross domestic product. So at what rate an entire economy is growing is basically GDP. So if we say India has grown by 9% year on year GDP, that means the country's total GDP has gone up by 9% year on year. So this is economic growth trends. Next thing is interest rate forecast. This is a very important component while analyzing any company or any industry or any economy. What is the interest rate? Because the business houses, the large organizations, if they want to expand, they have only two alternatives. That is, they can either fund their projects with their own capital or they can borrow from banks. And for this borrowing, they have to pay interest on that particular borrowing. So if the interest rates are too high, like in developing nations like India, where the borrowing rate is around, let's say, 9 to 10%, then it is very difficult for companies, and it is mandatory for companies to generate at least 9% return on investment in order to just finance their borrowings. So interest rate is very important in our analysis. And for companies, where if in a given economy, if the Reserve Bank of that particular country reduces the rate, the interest rate, in that case what happens? That business organizations, they feel more comfortable to borrow more and more capital at a lesser rate, and also their EMIs, their installments comes down, their interest burden comes down, resulting in their profit going up. Now, political developments. This is a very important topic while you are doing macro as well as micro analysis. So let us take some example of current political developments. You guys must have heard of, in February 15th, 2022, currently there is a huge tension between Russia and Ukraine. And because of this geopolitical tension, the commodity market, the equity market is completely in turmoil, especially the equity market, where in global indices we have seen a sharp correction over the last week. And in commodity prices, if you look at the commodity trends, the price of Brent crude is now trading at $95 per barrel, and it is trading at 7 years high. Whereas aluminium, it is trading at around 13 years high. Why this is happening is European Union, Eurozone, European countries are hugely dependent upon imports from Russia. They have huge natural gas reserves, and European countries are completely dependent, not completely but hugely dependent upon Russia's export to European countries. And due to this uncertainty, we can see that there is a huge volatility in the equity market and a huge uptrend in the commodity market. So this is why political developments are of paramount importance. Just 2 or 3 years ago in 2019, we remember how US and China had their trade war against each other and how it impacted even the Indian companies. And as macro is based on microeconomy, so small drops of water makes an ocean, right? So just like that, starting from a very small country up till countries like Russia, it entirely putting it all together, Russia, India, China, Bangladesh, Pakistan, Sri Lanka, Middle Eastern countries, Dubai, Iran, Iraq, Armenia, Azerbaijan, putting all these countries together, it makes macroeconomy. And in that entire global economy or macroeconomy, India is just a small part. United States is a small part there. So, if you compare in respect to globe, then global economy is your macroeconomy and United States economy is microeconomy. Similarly, global economy is your macroeconomy and India's economy is your microeconomy. So while you are analyzing macro and microeconomic trends, then political developments are of paramount importance. Past and current sector trends. So Currently, entire world is pushing for EVs, that is electronic vehicles. If you remember, in around 2001, there was a market crash which was named as dot-com bubble. The market crashed in 2001 after the dot-com bubble crashed. But post that, many companies which existed in that time, currently there is no existence of those companies now. Only few companies like Amazon and few other handful companies in India also, like Infosys, like TCS, these companies survived that dot-com bubble crash and now they have excelled. So, if you consider the condition before 2001, so the entire sector was in a positive trend. After the dot-com bubble crashed, it took around 6 to 7 years in order to recover back the share price till the level of 2001. Similarly, in India or even around the world, as the real estate prices were rising before 2008, real estate mortgage real estate mortgage crash I'm sorry. So after that, in 2008, Lehman Brothers crisis took place. So before that, the real estate prices were skyrocketing, but post 2008 mortgage bubble, housing bubble crashed. After the global financial crisis of 2008, we have those price of real estate has never been able to reclaim back to its level of 2008. So this is past and current sector trends. And in IT sector now, after so many years, now we can observe that IT sector is again in uptrend. Stages of business cycle. This is also related to past and current sector trends. Whether your industry or your company is a small part of the entire industry, right? So, stage of business cycle means at what stage your industry is currently operating. Whether is it at the very bottom of the business cycle, or whether the business cycle is now at an uptrend, or whether it has reached on top, or whether the business cycle is now slowing down and the curve is declining. You must analyze that. If it is in an uptrend, then you should invest in that industry and any good stock, any good company in that industry. When it has reached the top, at that time it is time to book your profits, and when it is coming down from the peak of the cycle, then you must exit from that particular sector. Also, another important thing is monetary and fiscal policy. So in 2022, we have seen that as inflation was rising and it was at 40 years high at 2% inflation for US, so which was at 40 years high, and US bond yield was touching 2%. As a result, US Fed decided to hike their rates. So this was an example of monetary policy. And what is a fiscal policy? Shortly, you can understand Union Budget of India for FY 23. Now, industry analysis, as we earlier discussed, that we must do this 5-point analysis, that is macro and microeconomic analysis, Second is industry analysis. Third is company fundamental analysis. Fourth is valuation analysis and forecast. And fifth is ongoing review. So we have already looked at how you should be doing macro and microeconomic analysis. So now let us move on to the industry analysis. So what are some reliable sources to do industry analysis and from where you can analyze the industry and get the correct data? Is from website in India for industry analysis. IBEF is a reliable source. And you also have various industry specific websites by governments like steel.gov.in. Sectoral report by investment banks and brokerage houses is also a good source of information. And about industry analysis, if you want to know in depth of how you can analyze any industry, in that case please refer to our previous session where we discussed about how you can make an overview report on any industry. This video is available on our YouTube channel Value Search. Company fundamental analysis. So analysis. So this is the third step of company analysis of equity research, which is now focusing at company specific. So you guys must have heard of EIC analysis. E stands for economy, I stands for industry, C stands for company. So now we are going to look at company specific. Suppose you are currently covering IT sector. So in IT sector, TCS is one company, Infosys is another company, HCL Tech is another company, Tech Mahindra is another company, L&T is another company. So now, while you are going to analyze any company particularly, in that case, what are the sources you must look at? So the first and foremost and the most important source you must consider is analysis of annual report of last 3 to 5 years. So you should be reading at least last 3 to 5 annual reports of that particular company. If not available, that means if the company is newly listed on the stock exchanges, in that case whatever number of annual reports will be available to you, you can read those number of annual reports, plus you can refer to the RHP, that means Red Herring Prospectus. Also for companies who are listed on stock exchanges, you will find investor presentation, quarterly results, press release, con call transcripts, management interview on various news channels. So these few data like annual report, RHP, investor presentation, quarterly results, press release, con call transcript, these informations you will easily get from company's website. Or if you do not get these informations easily on company's website, although I would recommend you to go to company's own website and access this data directly from that source, but in some particular cases where you need it then and there, in that case you can refer to websites like bacindia.com or third-party websites like Tijori Finance. Although we are not promoting those websites, but yeah, only company's website and bacindia.com is the most reliable source of information. You can rely on these two sources. Next is management interview on various news channels. So this is of paramount importance because there, if you look at any management interview on any TV channel, so there you will find that the anchors are like grilling those management people like the CEO or CFO or chairman or anyone, any managing director, whoever has come for the interview. They will ask various questions, shoot various questions at them, and they have to answer it properly. Otherwise, the public at large will be watching them. So generally, from the management's answer that they are giving to the anchor to the public at large. From that point, you can actually try to understand what is the tone of the management. Are they trying to somehow hide anything from investors, or are they overly optimistic, or they are pessimistic? What is their confidence level? But one thing which is more important than confidence is how much clarity management really has. Because management knows most about his own business, what is happening in that particular business. Nobody knows except the management. Nobody knows better than the management. So, what management is saying, how management is saying, and what could be the intention behind of what is being said, you must analyze that from this news interviews and another very reliable source of information. And also through this you can analyze the management's character is that you can just directly listen to conference call audio. This is, I have written here, con call transcript. So the full form of it is conference call transcripts, but it will be really helpful for you if you go through at least last 2 or 3 quarters con call. It will be easily available on YouTube now. So you can just search company's name, let's say HDFC Bank conference call FY 22 Q3, and you will get the con call available on YouTube. The next step is doing trend analysis of EPS growth rate. That means suppose for any given company, let's say XYZ company, for XYZ company their EPS was 5 rupees in 2020. Now in 2021 their EPS became 1.8 rupees per share. In 2022 the EPS became 2.5 rupees per share. In 2023 it became 3 rupees. In 2024 it became 4 rupees. In 2025, so from 5 rupees it became 6 rupees. From 2020 it was at 5 rupees. In 2021 it became 6 rupees. From 2021 to 2022 it became, let's say, 8 rupees. 23 to 24 it became 9 rupees. 24 to 25 it became 10 rupees. So 5 to 10, what should be the CAGR, compounded annual growth rate of EPS? You must calculate it and try to analyze what is the trend. If the EPS is growing continuously, if the CAGR is stable, or it is so much bouncy that from 5 rupees, from the EPS of 5 rupees it is going up till 10 rupees, then again it is coming down to 4 rupees, then again it is going up till 11 rupees, then it is coming down to 8 rupees, then it is going up to 15, then it is coming down to 10 rupees. So what is the actual EPS trend? Is the trend is positive, or it is too much of deviating, too much of up down is happening in the trend? So if the EPS is going up and down, up and down, up and down, again and again, again and again, in that case you must understand that there is not really stability in the profit earning capacity of the company. So you can also call these companies cyclical companies. Cyclical means seasonal companies. That means in a particular situation the earning capacity of those companies increase, and at certain situations it dramatically comes down. So the example of any cyclical industry is metal industry, automobile industry, banking industry. Yes, even banking industry is also considered as partially cyclical, because if there is economic downturn, in that case the earnings of banks goes down, because there is a greater chance, greater threat for new NPAs coming in banks books. So what are the other things, other trends you must analyze is company's margin. That means operating profit margin or EBITDA margin and net profit margin, or even price net profit margin, EBITDA margin and PBT margin, profit before tax margin. You should be analyzing all these margins. The trend of this margin is the EBITDA margin or the operating profit margin is rising continuously, or it is going up and going down, going up and going down. So you must analyze that trend. And what is the CAGR of it? You must analyze. So CAGR of revenue is another thing. At what CAGR the company's revenue is growing? And again, is it going up and down, up and down, up and down, up and down? So what is the standard deviation? Like, is it going up too much all of a sudden and it is completely hitting the ground, again rising and touching the sky, again is it coming down and falling on the floor? So is this the trend? So what is the deviation? If it is not deviating too much and the CAGR, if the CAGR is not deviating too much, the growth trend is not deviating too much and it is consistently growing, in that case it is a really positive sign and it ensures investors that yes, this company can continue to grow in this positive trend. So this is the CAGR of revenue analysis. Now EBITDA you must analyze as I have already described, net profit and trend of the industry and its main competitors. Okay, so this is a really important thing you must consider, that is your own company's CAGR revenue, means at what compounding annual growth rate your revenue is rising for your own company, for EBITDA of your own company and net profit of your own company versus trend of the industry. Suppose your company is, let's say your company's total revenue is rising at 10% rate year on year. So your company's CAGR of company's turnover is, let's say, 10% and the entire sector is growing at 15%. So if the entire industry is growing at 15%, let's say IT industry is growing at 15% and the company that you are analyzing is growing at 10% CAGR. So would you consider it as a good sign or a bad sign? Definitely a bad sign, because your industry, that means many companies putting it together who produces same kind of products or renders same kind of services, those companies putting it all together becomes an industry, and all of them putting together on an average they are growing at 15% and your company is growing at below average rate of 10%, which is really a big turnoff. So at what rate your industry is growing versus at what growth rate your company is growing versus its main competitors. So what do you think? Who are the main competitors for, let's say, L&T Technologies? It is generally companies like TCS, companies like Infosys, right? So they are the big boss, they are the big brothers, they are the eldest one, strongest competitors in this particular IT industry. Suppose if TCS is growing their top line, means their total revenue by, let's say, 10% year on year, and the industry growth rate is also 10%, and if L&T Technologies is growing their total revenue by, let's say, 20% year on year, then it is a really good sign. Now, what are the other things you must consider is that market share growth. Suppose, let's say, India's total steel production capacity, the steel produced by India in calendar year 2021 was 118 million tons. In that particular calendar year, Tata Steel produced around 35 million tons of crude steel, which is around 30% of the entire market. But if you look at the past few years, capacity expansion and market share growth for Tata Steel, it has been quite flat. But if you look at companies like Jindal Steel and Power, they have almost grown their production capacity by 50%. As a result, they have grabbed more market. Suppose you had, let's take an example. You had 10 biscuits in your hand and you had 3 friends to share with. Now, okay, let us say you had 4 friends to share with. So, all of you had 2.5, 2.5, 2.5, 2.5 pieces of biscuits. Now, another friend has joined this party, and now how what number of biscuits you will have? Each of you will have 2 biscuits, right? So you had 10 biscuits, you had 4 friends, so you were dividing it as 2.5, 2.5 each. Now another friend has joined, so now how you have to share those biscuits? 2 equally, right? But in market now, but let's say one of your friend was really naughty and he tried to snatch biscuits from your hand. Looking at that, another friend also tried to grab some more biscuits from your hand. Looking at that, you tried to retain back all your biscuits in your own hand. Looking at that, another friend also came and tried to snatch biscuits from your another friend. So this is the competition is actually happening, and this is competitive rivalry of gaining more and more market share or more and more biscuits. That means 5 of your friends along with you were fighting to get more and more pieces of biscuits. Similarly, companies also fight in any particular industry in order to gain more and more market share. And let us say, suppose all of you had 2 biscuits. Now, if only one of your friends, among those 5 people, only one of your friends, if he could just take one little bite from the biscuits of rest 4 of you, he actually could have ended up with almost with 2.5 biscuit, and all of rest of you would have lost some of your biscuits, right? Some portion of your biscuit you would have lost if one of your friends came and took a small bite from each of your friends. So this is how competitors eat out the market share from the existing players. Now, another thing you must analyze is competitive advantage. So let us take the same example of 5 friends. Suppose one of these 5 friends, if he happened to be really muscular, well-trained physique, athletic personality, really strong, so in that case probably that friend would have been able to snatch more and more biscuits from other friends. Another way is, if a particular friend among the group of 5 friends were really dear to all other friends in that particular group, most probably they would have shared some of amounts of the biscuits that others had to that particular favorite friend. So these are competitive advantage. That means what advantage you have. Either it can be geographical advantage, your supplier advantage, your economies of scale advantage, your pricing advantage. It can be of anything. Technological advantage, research and developmental advantage, partnership advantage, like that. So also try to analyze how a company creates its own blue ocean. So what is a blue ocean strategy? A blue ocean strategy means, in an ocean, suppose there is a troop of fish and all of them are trying to bite each other to survive. So let us take our example once again. 5 friends were now so hungry and so angry with each other that they started now beating each other very badly. And some got wounded in their face, some on their hand, some on their cheeks, anywhere. So it was a bloody fight. Everyone was oozing blood. But now, let's say you thought that What's the point of this fight? You had only two biscuits in your hand, you just ate those two biscuits only and got satisfied with it, and then you, let's say, had a packet of chips. So you started eating that particular packet of chips, and no one was interested or even willing to eat that chips, or they didn't even see, and you hide from those friends and alone you just ate that packet of chips. So that is what blue ocean strategy is. If you remember what Jio did, Reliance Jio, when they introduced their service, they didn't invest their investment in 2G technology or in 3G technology. They just simply directly invested in 4G technology. They just completely upgraded themselves to 4G service network service provider, and see how they disrupted the entire market. They gave the service, they provided the service for free for almost like 1 year, and after that they started charging. So they just grabbed the largest pie of the entire market share, where companies like Telenor, Uninor, Tata Docomo, Aircel, Reliance Communication, Vodafone, Idea Group, all these small companies. Actually, Idea was quite large at some time, and also many other companies who were at that time existing in India. All of them had to shut down. Aircel was also a huge network provider, but all of them either shut down or they had to merge with other businesses, as Aircel merged with Reliance Communication and both failed. Idea merged with Vodafone and became Vodafone and Idea. Tata Docomo probably even shut down their operation or probably sold their operation to some other competitor in the market. So, with this completely new technology, new investment, new strategy, Reliance Jio created their own niche market of 4G. So, it is said that if you compete and work hard and do your best, you can be number one. But if you are unique, you are the only one. If you are the best, you are number one. If you are unique, then you are only one. So this is your blue ocean strategy. Now let us look at what Harpic has done, what Gillette has done, what Jockey has done. Same product, undergarments, and let's see, just look at how other companies are competing a bloody fight, but Jockey has created their own brand. How Domino's Pizza is almost running a monopoly in Indian pizza market. So this is a blue ocean strategy. Product positioning. How you are positioning your product in the market, that is of paramount importance, and it creates a competitive advantage. Like Dove soap is considered to be for elite class people. For soaps like Lux, it is for middle class one, and like Lifebuoy and those kind of soaps, it is kind of presented as it is a lower middle class or poor man's soap. Similarly, if you look at Asian Paints, they have Asian Paints Ultima Protect for exterior paints, and that is the most premium product. They also have Asian Paints Ultima. They also have Asian Paints Apex. They have Asian Paints Apex, which is a middle class range, and they have Asian Paints Ace, that is a least price, that is the least costliest product that they have in their exterior brands. So they have three products in three different market segments. So they are catering the entire market. They are winning the entire market, and they have around 51% market share. And probably, I think Asian Paints is the largest paint manufacturer in entire Asia. It is the number one. It is at number one position. So how they have owned this market is they have product for the richer class, they have product for middle class, they have product for poor class people. So this is brand positioning. Asian Paints Ultima Protect, they are positioning this brand for the elite class. They are positioning Asian Paints Apex for the middle class people and Asian Paints S for poor people. Brand value and brand pool is another very important thing you must analyze. So when you think about pizza, it's Domino's. When you think about phone, although you may not have that much of money, but you generally think of iPhone as a symbol, as a standard. When you think about paints, it is Asian Paints. When you think about bank, it can be either State Bank or HDFC or ICICI Bank. If you think about life insurance, it is always LIC, like that. So, if anyone hears about your brand only, then they get pulled towards that particular brand because it has a great recognition, a trust attached with that particular brand. Now, expansion strategy you must analyze of a particular company. How they are financing their expansion plan. Are they doing this capex or this spending or this investment from internal sources or they are employing external borrowing? You must understand that because it has potential risk involved. So you must be analyzing that very, very carefully. You must analyze what is the debt profile of a company. What is their leverage situation? You must analyze company's capital structure. You must analyze standalone versus consolidated figures. So standalone means its core business and console means standalone business plus joint ventures and subsidiaries. So you must analyze all the business segments that one company may have. Understanding of each line items is really, really important. What are those line items? Those are revenue from operations, other income, other expenses, direct expenses, etc. It also includes employee cost, depreciation, amortization, and also other expenses in profit and loss account. In balance sheet, you have various items like you have non-current assets, you have long-term liabilities, short-term liabilities, equity, etc. In cash flow, you must analyze cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. And what is the net cash flow of that firm? And after reading all these financial statements, then you should be reading the notes to accounts. If you are analyzing total revenue, it may not present a perfect picture to you. So in order to understand what are the constituents of this particular amount of total revenue, what is the revenue sources, what are the key revenue drivers, in that case you should refer to the notes to accounts. If there is any expenses there, any other expense, any employee expense, any finance cost, you must refer to the notes to accounts in order to analyze and understand each and every line item that may be present in your financial statements like profit and loss account, balance sheet, and cash flow statement. You must also do ratio analysis. Ratio analysis is of paramount importance because if you try to analyze two different sized firms, let's say for company A, their total turnover is 10,000 crores, and for company B, their total turnover is, let's say, only 100 crores. So 1,000 crore and 100 crores, if you compare these two companies, okay, let's say 10,000 crores and 1,000 crores. Total revenue for company A, let's say, is 10,000 crores and total revenue for company B is, let's say, 1,000 crore. Now, if company A earns, let's say, 1,000 rupees net profit upon 10,000 rupees of total revenue, then the net profit margin is 10%. But if company B earns 200 rupees upon 1000 rupees, it is 20% net profit margin. So how you came to this conclusion? You just analyzed these figures and expressed it in a ratio format. Now, can you tell me which company is more profitable, company A or company B? So you will say it is company B. So how you arrived at this conclusion? As you must have noticed, in company A, the total turnover was 10,000 crore rupees, and for company B, it was 1,000 crore rupees. The total profit for company A was 1,000 crore rupees, and for company B was 200 crore rupees. Still, in spite of company B making lesser sale than company A and earning more profit than company A, company B is actually generating more profit, and it is comparatively more profitable than company A. Next thing you must do is management discussion analysis. You will find this particular section in any annual report of a company, where you can understand what is happening in that entire company, and there the management of the company will be taking you and guiding you through the entire happenings of that particular company. The directors report, the board of directors of that particular company writes this report to the shareholders to express and let them inform the investors what is happening in the business, what is happening in the industry, what is happening in the economy. Auditors report. Auditors are those who check the numbers, who check and try to analyze the authenticity of the numbers, the accuracy of the numbers, what they have to say about the numbers that company has disclosed. Corporate social governance means what they are doing. Is this corporate group responsible or not? Just one example would be enough for you, that is Tata Group. Compared to various other companies who are running their business so successfully, but Tata Group, I don't have to say anything about Tata Group. In company fundamental analysis, what could be some potential external sources is that you must go through brokerage house reports, other equity research reports like initiating coverage report, result update report of any company, or flash report of any company. And you can also read or refer to rating agencies report. And you must also try to understand and analyze the ESG condition of that particular company. ESG stands for environmental social governance. The next thing, after analyzing about the entire business, entire economy, entire industry, now this is the time for you to value the company. Whether this company is available at a fair valuation, or it is too much expensive, or it is undervalued, you must try to analyze that. For that, intrinsic value analysis, relative valuation, earning forecasts are required to be done. In our session, in our current shift, we are not going to cover anything about valuation, anything about forecast, because if you do not understand what has been explained in past few slides, then there is no way you can understand what is going to be the forecasted revenue, and whether a company is undervalued or overvalued, and what is the reason behind it, how to discount cash flow. If you do not understand the business and its trend, then you won't be able to correctly evaluate this very important data. Although this particular point, this is our fourth point of analysis, although this is of paramount importance, this is very important, but for now let us skip this particular point. And then the last step is ongoing review. Suppose you have made a research report on, let's say, Tata Steel in 2019. Now 3 years has passed. Many changes have taken place in terms of raw material prices, in terms of global economic situation, in terms of political situation, in terms of ESG situations, and many other things like research and development and many other things. So if you haven't done the review of company's numbers, company's business model, company's operational strategies, company's research and development, and etc., then if you are not updated, if you haven't updated your research report, then this is of no value. The business world is so dynamic that it takes only few seconds to change instantaneously. So you must be looking at these changes very carefully, and any update that is there in the economy, in the industry, or for your company specific, you must be closely observing those changes, and accordingly you must review and analyze those new happenings, and accordingly you must work on your report to improve it day by day on a periodical basis. So this was all from our side on what are the key points you must remember while you are trying to make an equity research report. Now let us take you through just a brief sample of how it may look like for beginners. This research report was prepared on 27th of May 2021 on JSW Steel. So here I have introduced the readers with the company, what the company does, how this company operates, what is the production capacity of this company. I have described it over here. Then I have showed the operational presence of this company. Operational presence means where this company is located, where its facilities are, where does it operate from. Their manufacturing units I have showed here. And then, as this is a manufacturing farm and it is hugely dependent on its availability of raw material at a short distance and captivity of sources, so I have briefly discussed about the captive mines that they have. Then I have discussed about company's product portfolio. Means what are the products that the company sells and what are the categories of product that a company sells. So for a steel sector, it is flat products and long products. For companies like ITC, they have FMCG business, they have hotel business, they have agro business, they have stationery business as well. In FMCG sector also, ITC has two businesses, that is FMCG tobacco and normal FMCG. So this is the product portfolio. Then I have given an industry overview in which this company belongs. Then I have shared top 10 steel producing nations and what is their production capacity and their increase or decreasing trends in production. Then here I have shared share of global steel production in percentage term. Then I have shared the sector wise, that means sectoral consumption in India. You can also present this data globally and for your own country. Growth strategy of the company and company's targets. Then the current financial year under review, global scenario, what is happening globally, and the main driver, a key metrics for this particular company is metal prices. Its profitability is hugely dependent upon the metal prices. So I have done a review of FY21 global scenario, what are the prospects for metal industry and the prices of metals. Then I have discussed here about raw material requirement, what are the raw material required for the production of this steel. Key demand drivers, revenue segment, and what are the things that drives company's revenue. Then I have shared here company's annual performance in FY21, and also I have shared about company's ongoing new projects. So here I have discussed about company's annual performance, company's debt profile, company's ongoing projects, company's new project that the company is going to venture into, updates on key merger and acquisition, performance of major subsidiaries, joint ventures. Then after this business analysis, I have come to company's shareholding pattern. Key institutional shareholders, and after that I have gotten into company's financial highlights. This is in standalone basis for last 5 financial years, and this is in consolidated basis for last 5 years. Brief financial estimates. These are some key ratios, key point of analysis that I have included over here. Key balance sheet item that I have included over here. Key cash flow items, I have also included this thing over here. And then this company's production and delivery statistics. Government's initiative, government's focus on this particular industry. What is the tax condition? What are the PLI schemes? What are the incentives given by government? How government wants to boost the production and sale of this industry. Overall business outlook and key managerial people. So with this, I have ended my report. So now, whatever steps I have shared over here, if you follow these steps, you will be able to make equity research report on any given company. So with this, I wish you all the very best. Namaskar all.